Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. There's been a lot of talk about the future of streaming, particularly for a company like Disney, which is seeing a lot of disruption in its linear TV networks, and then Netflix reducing the amount of password sharing that it has, adding advertising, the content uncertainty that we have there. But I think one of the things that's become clear over the last 6 to 12 months is that the future of streaming really comes down to monetization from advertising. And I want to show exactly how lucrative that could be through what we know from Disney and Netflix. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. Now, one of the ways to look at how much potential revenue there is in advertising is look at how companies are pricing their services. We have seen over the last 2 or 3 quarters that companies are explicitly saying that what they're trying to do is increase the difference between the ad-supported tier and the premium no ads tier to account for the fact that they're making a lot of advertising revenue. So we can get a proxy for how much opportunity there is in advertising to see by just looking at what the difference is between those two pricing tiers. I'm going to start with Disney. Disney actually has 3 different services. Eventually, those are going to end up in one app, but we can kind of get an idea for how much opportunity there is in advertising by looking at the pricing of at least 2 of these services. Disney Plus is going to be adding more advertising, and starting on October 12th, it's going to cost $13.99 per month, which is a 27% increase from the previous price. The ad-supported version is going to be $7.99 per month. So $6 per month is the delta, or the difference between the ad-free and the ad-supported version of Disney Plus. That's how much value they're apparently seeing from advertising. Hulu, which is majority owned by Disney, will likely be fully owned by Disney in the next year or so, has actually a $10 delta between ad-free and ad-supported. $17.99 per month, again, starting on October 12th, compared to $7.99 per month for ad-supported. So Hulu, they're seeing a $10 difference. So that's, I think, a good proxy, is the $6 to $10 per month in difference between the ad-supported and ad-free versions. Now, Bob Iger on the most recent conference call explicitly said that we want to push people to the ad-supported version. So that gives us an indication there the revenue opportunity for Disney is likely even more than the delta between these 2 price points. For Netflix, we see something very similar. They've been changing their pricing structure a little bit over the last year, but standard with ads is now $7 per month. Standard without ads is $15.50 per month. So $8.50 is the difference between those 2 versions. That, again, should be a proxy for what we see in the revenue opportunity for Netflix in the ad space. Getting an understanding of how much revenue opportunity there is in advertising is really important for streaming, because the lower they can have that price point, the more opportunity there will be to add customers, the lower barrier to entry there is. And you can see that revenue from advertising likely exceeds what a lot of these companies were charging just a couple of years ago for their streaming services. So as we look forward, it's possible that we start to see different tiers that maybe even start with free and just ad supported. This will hopefully broaden the base for a lot of these companies, whether it's Netflix or whether it's Disney. And as we think about the future of streaming and content, and a lot of the content that is currently on linear TV or cable, think about things like sports, there's an opportunity to potentially broaden that base and yet bring a lot of money into the ecosystem just through advertising. I still think that we will also see some deals that end up being revenue sharing deals. So a little bit like the Spotify model, where these streaming companies say, hey, we're not going to guarantee you a certain amount of money like we might have done in the past. We're going to actually cut you in on the revenue that we're generating. So think about the NBA or NFL. Those are potentially going to make even more money on streaming from an advertising perspective than they did with traditional TV, especially if you're showing all of their games and not just a subset of games. So this will take some rethinking of the industry and exactly what the business model is, but the numbers are really big. I think it's pretty clear that there is a lot more value in advertising in streaming than there is in linear TV. The numbers are just much bigger on the ad per subscriber basis than it is in linear TV. And that's something that we're hearing across the board. So watch for this to be a bigger and bigger piece of the business model for companies like Disney and Netflix that are really leaning into streaming. But what do you think about the future of ads in streaming, the likelihood that we're going to see a lot more advertising? Love to hear your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.